Welcome back to the most popular series on my channel, our monthly deep dive stock analysis. Today we are going to be covering McDonald's, which is one of my top 5 favorite companies of all time. I want to accomplish 3 things today. I want to show you why you do not need to invest in high-risk companies to achieve extraordinary performance in the stock market. Second, I want to show you how Warren Buffett and other value investors determine the intrinsic value of McDonald's in multiple ways. Third, I will provide some guidance on whether this analysis indicates if McDonald's is a buy at its current prices in July 2020. Without wasting any time, let's get started. We start by looking at the screens. The only thing worth mentioning here is that McDonald's share repurchase program has reduced the effectiveness of the price to book screen. Thus, we will ignore it and consider it as a fail. Based on my absolute targets for the screens, McDonald's fails in each category. McDonald's also doesn't fit the qualitative screens, as it is not a spin-off, it is not in an obscure industry, nor is it a boring company, all of which indicates that McDonald's likely isn't undervalued from an asset appraisal perspective. Rather, the intrinsic value of McDonald's is dependent on management's ability to create sustainable competitive advantages and protect their market share. Therefore, most of the attention in this video and in your analysis should be spent on strategic analysis and an EPV analysis. Ultimately, a company can be incredibly undervalued, but if the rest of the market doesn't eventually realize the company's value, you may not have a very good investment. So let's take a look at some catalysts that can create tremendous value for McDonald's over the next couple of years. First, the current recessionary environment or market turmoil creates tremendous value and demand in the fast food industry. Given that McDonald's has the largest market share in the industry and some of the most affordable products, they stand to benefit the most from this situation. Second, the McDonald's Velocity Growth Plan is about to kick into stride. McDonald's has been focused on using technology to drive strong growth, which has been vastly successful so far, but it's going to see even more success soon. The current pandemic has forced consumers to download the McDonald's app or get used to ordering delivery. Research has shown that consumers using these types of ordering methods spend 2 to 3 times more than consumers who order through traditional methods, such as going up to the till. Third, McDonald's new franchise structure with the Velocity Growth Plan creates a link between demand advantages and economies of scale. Typically, it's seen as a bad thing when a company starts offering coupons or lower prices to consumers, as this negatively impacts margins. However, McDonald's makes the vast majority of their money by taking a % cut on the revenue their franchises generate. Therefore, when McDonald's begins offering regular revenue-generating coupons on their app, McDonald's makes cold, hard profit with none of the risk. For example, a common coupon is to get 2 Big Macs for $3 each. If we assume a regular consumer buys 1 Big Mac per visit, they would pay $5.69 before tax. But with the coupon, they may be willing to pay an extra 30 cents more for the extra Big Mac. McDonald's now earns 5% additional profit on that difference because they don't incur any of the costs of the Big Mac. Their franchise does. All McDonald's is doing is charging their franchise fee, which is the 5%, on any additional revenue. McDonald's is a unique company where the consumer is easily able to scale their order size without even noticing. I will cover why each of these catalysts are likely to be realized at varying points in the video. Let's get started. The 2 main industry reports I used to accurately determine the growth potential and key success factors for McDonald's were the Global Fast Food Restaurants and Fast Food Restaurants in the US reports from IBISWorld. First, we need to ensure that McDonald's operating model matches the features stated in these reports. These features were 1. Customers pay for their food prior to eating. 2. The restaurant sells beverages. 3. Goods can be eaten on site, taken out, or be delivered. 4th, the companies in the industry have 2 sources of revenues: franchising dollars and revenue from company-operated and owned stores. These features perfectly match McDonald's, and so the insights driven from the report are likely to be extremely valuable to our valuation. On your screen is a summary of the key drivers of economic growth and the impact they have on the fast food industry. Overall, we see extremely positive impacts for the fast food industry in the future. A key thing to note about this research is that most of it was published ahead of the economic turmoil the market is currently facing. Thus, we need to see how the industry has performed relative to broader market movements in past times of economic turmoil. The figure on your screen provides an illustration of nominal revenue growth in the fast food industry relative to overall market movements of the S&P 500. The insight we can drive here is that overall revenue growth across the industry typically doubles anytime there's market turmoil, which suggests opening a position in this industry at these times can be extremely lucrative. Given that McDonald's has the largest market share in the industry and some of the cheapest products, it is likely to benefit the most from this revenue growth. Next, it's important to consider the overall key success factors for the industry. On your screen, you'll see the most important KSFs for the fast food industry. Again, McDonald's is in a position to benefit the most from these KSFs. McDonald's' incredibly tough requirements for a prospective franchisee to open a location self-selects owners who have business expertise and a strong understanding of the market. Further, McDonald's has chosen to remain a pure play, which has created substantial brand value. This additional brand value gives them access to top talent such as operational analysts to control costs, strategists to focus on its value proposition and market research, top executives to run the company, and it creates demand amongst individuals looking to open a franchise. Therefore, McDonald's is able to meet or exceed what is expected from these key success factors. Finally, it is important to look at a visual that highlights the dynamics of the industry and the interconnectedness of these dynamics on the ability for firms to generate profit. On your screen is a Porter's 5 Forces visual of the industry. What we want to see here is a very tight diamond and a circle with the lowest possible values. So based on those criteria, this industry does not actually look incredibly attractive at first sight. But this is a very good thing for McDonald's. This is an industry where new entrants will struggle and incumbents with an established brand benefit from this challenging industry. The only change I expect to see in this visual is to see the rivalry increase from level 2 to level 3 as global growth slows and the market size begins to stagnate. The Porter's 5 Forces is a simple tool, yet it is one of the most powerful tools that help investors find great industries to invest in. And I'll be making a detailed video on how to perform and read and understand this analysis in another video. For now, let's move on to analyzing McDonald's itself. To start, we will look at the business risk of McDonald's based on numerous factors. Overall, we see that McDonald's is well positioned in the industry to benefit from the variety of challenges discussed above. A few important business risk factors will be discussed below, and their impact on lowering business risk will also be exemplified. First, we have the company's corporate structure. McDonald's has altered its restaurant ownership model to move towards a 95% franchised model. This is an important feature as this substantially lowers business risk for McDonald's. This is because of the way McDonald's extracts revenue from their franchises. Initially, franchise owners pay a fixed startup fee that's largely irrelevant in the long run. However, on a yearly basis, McDonald's charges their franchisees 2 separate fees. The first is a variable amount, which is a 3.5% royalty fee on the revenues the franchise generates. The fixed component is a mandatory rent payment the franchisee must remit to McDonald's. This not only allows McDonald's to practically eliminate financial risk, which, if you remember, is the risk of becoming insolvent, missing debt obligations, etc., because they can limit their mandatory outflows to the minimum inflows per month based on fixed rent obligations. Any upside on top of these fixed revenues from the variable royalties can be used for 3 main purposes. First, any CapEx required to open new stores, buy new land, or renovate company-owned stores. Second, to increase dividend payments at a stable rate. And third, and possibly most importantly, the excess cash can go towards share repurchases. Since McDonald's operates mostly using franchises, only a small portion of this excess cash ends up going towards CapEx, which is another major benefit for shareholders because it means a lot and most of this free cash flow can be and is returned to them in the form of dividends and share buybacks. Second, we need to look at how McDonald's is positioning itself for the future and if this is going to reduce their business risk. I believe McDonald's is very well poised for the future due to a strategic initiative spearheaded by ex-CEO Steve Easterbrook. The plan is to implement technological change to the firm that will drive top-line sales growth. Research showed that a consumer placing an order through an app for pickup or delivery was likely to spend 2 to 3 times more per order than a consumer ordering at the counter. Now that some data from app spending is coming in, we know that the executives and the research were both correct. Further, the pandemic has led to government officials promoting these fast food apps, so we are likely to see a massive increase in app adoption levels amongst consumers. This will massively improve McDonald's top-line sales, and since the firm's costs are mainly fixed, it will have an exponential improvement on their profits. Third, we need to look at McDonald's margins, size, positioning, and track record relative to the industry. A summary of these features will be displayed on your screen. Overall, everything I found here points to McDonald's being a far safer investment relative to their peers. Ultimately, I decided McDonald's faces low business risk, implying an optimal capital structure of 50 to 70% debt to value. Next, to determine McDonald's financial risk, I needed to look at how McDonald's target capital structure has changed over time. On your screen, you can find a breakdown of McDonald's 10-year capital structure, which I have broken down into 5-year components due to a strategic buyback decision that management took in 2015. What I found is that McDonald's looks to be operating outside of its optimal capital structure with too much debt. However, I also wanted to analyze the capital structure using market values, as the book value method seems to be materially impacted by the share repurchase plan. Here, I saw that McDonald's has maintained a very steady debt-to-value ratio. Something interesting to note here is that McDonald's crafts their debt limit not based on their debt-to-value ratio, but rather on the following computations. This information shows us that McDonald's attempts to match their mandatory debt outflows with the minimum cash inflows. This, in my opinion, is the perfect way to scale debt while limiting the added financial risk. For this reason, I will assign McDonald's a medium financial risk. So with a low business risk, a medium financial risk on top of that implies that McDonald's is likely operating with a credit rating of AA to A. To confirm whether my intuition is correct, I solved for the yield to maturity of a recently issued 10-year McDonald's bond. The calculations are shown on your screen now. A cost of debt of about 2.13% seems to reconcile with our intuition of an A rating. However, something to note is that McDonald's current bonds outstanding have been given a BBB plus rating, which is one level below an A rating. Therefore, it seems to indicate that markets are expecting McDonald's is operating with medium business risk. However, given what I have discussed above and some other points I'll mention in this video, I'm comfortable taking a contrarian stance. Using low business risk, medium financial risk, and A credit rating, I got an implied equity risk premium of 3%. Based on the value investing method, I found a cost of equity of 5.13%. Using these inputs, I solved for McDonald's WACC, which resulted in a value of 2.37%. However, I also wanted to showcase what the WACC of McDonald's looks like under the CAPM method. Under the CAPM method, it seems that the market is pricing McDonald's based on medium business risk, and because the CAPM uses market weights, the WACC is inflated relative to the value investing method, which gives it a value of about 4.62%. However, what's important to note here is that McDonald's WACC is low based on both methods, signifying that the company is able to raise capital at inexpensive rates regardless of who is performing the analysis. To continue with my analysis, I used only 5 years of data due to management's share repurchase plan changing the structure of the company in 2015, and due to management moving toward a 95% franchise structure in the same year. To start, I computed a 5-year average first pass ROIC, which I found to be a massive 22.03%. Take a moment to appreciate just how incredible this is. Management pays around 2 to 4% to secure capital, and then is earning 22% by using this capital. So since ROIC is significantly greater than the WACC, this suggests an EPV significantly greater than an NAV. And this also suggests that management is creating significant value for its shareholders, which the stock price has certainly shown over time. However, I do expect the second pass ROIC to be lower than the first pass due to hidden and replacement values of assets. Further, McDonald's ROIC is in the top quartile of its competitors, and it offers the lowest WACC amongst its peers. Simply put, McDonald's is offering a higher return for lower risk. This is what makes McDonald's truly one of the best stocks on the market today. Further, I computed a DuPont ROE analysis to see what was driving McDonald's significant returns. What I found was that McDonald's increasing reliance on franchise stores as opposed to company-owned stores makes it look like their sales are declining year over year. However, this is certainly not the case. So pay no attention to the asset turnover ratio declining here, as it is actually improving on a year-over-year basis. The main things to marvel at for McDonald's is that their profit margins have improved significantly, and they will continue to improve moving forward. Second, management has been extremely competent with their use of debt and have effectively caused the ROE to skyrocket with intelligent restructuring. There are a few other gems in the stock market making the same moves today, and if you want to see these amazingly run companies combined in one video, let me know in the comments below. I will now cover the numerous ways I've valued McDonald's, starting with an NAV analysis. On the asset side, the main accounts I'll discuss here are the hidden asset values and McDonald's real estate. As it currently stands, McDonald's real estate portfolio is definitely one of the strongest in the world, if not the strongest. Here are two figures that will demonstrate just how valuable this real estate is. The first image on your screen now depicts the controlled territory of the 8 largest fast food burger chains in the US. The second image depicts the map of the US by the nearest distance to a McDonald's. As you can see, McDonald's is light years ahead of their closest competitors in the US, and this real estate expertise transfers across the globe. These factors make it nearly impossible to accurately value McDonald's real estate, so I've made a simple approximation. In terms of the product portfolio and customer relations values, you can look at your screen to see the steps I took to approximate the value of these hidden assets. In general, please feel free to pause the video and read all the assumptions and formulas I use, which you can find to the right of most numbers. While I would love to explain how I get every single number in these analysis videos, it would probably take me around 10 hours to cover everything. Next, we need to look at the liability side, and the major account we need to cover here is the adjustment that I need to make to get the market value of McDonald's long-term debt. There were notes given in the annual report that helped compute these figures. Because McDonald's cost of debt and the fixed interest rate on their debts differed by more than 0.4%, I used a composite bond formula to determine the market value of McDonald's fixed portion of debt. I then simply summed the variable portion of their debt on the balance sheet and this computed fixed portion of debt value that I found, and that was the market value of their debt. Next, I needed to determine the value of the employee stock options that McDonald's has issued. I used the Black-Scholes method of analyzing these stock options, and I found that the assumptions used in the annual report were fair and reflective of normal market conditions. Overall, this analysis resulted in a net asset value of $64.54 per share. Since I expect the EPV of McDonald's to be significantly greater than the NAV, this low NAV value is consistent with my intuition and the analysis done so far. Further, asset-efficient companies like McDonald's are usually valued based on their cash flow generating capabilities rather than from an NAV perspective. Finally, let's not forget that my approximation of McDonald's real estate value likely significantly underestimates the true value of their real estate portfolio. That being said, let's move on to the EPV analysis of McDonald's. Value investors like Buffett always first analyze a company with the assumption that there will be no growth expected moving forward. They then normalize the company's cash flows over the past few years to avoid forecasting cash flows forward during either a recessionary or expansionary year of cash flow. This is a conservative way of computing the EPV of a company and something I always do as well. You can see the no growth free cash flow schedule I made on your screen right now. The only complex breakdown in this case is the zero growth CapEx. There are two methods of performing the computation. Method 1 of the zero growth CapEx calculations was effective at showing that McDonald's is trying to grow, but they are very selective in the methods and the time frame. Note that 2017 was an outlier year, with most CapEx being allocated to growth, likely due to the kiosks rollout after 2015 testing. However, zero growth CapEx and depreciation are roughly equal, so I will make them equal in the no growth free cash flow schedule so that I do not penalize or advantage the company into perpetuity. Based on this analysis, we get an EPV per share of $304.23. Assuming no further growth. Therefore, our intuition was correct, and the EPV of McDonald's is significantly greater than its net asset value. Finally, I performed 2 second-pass ROIC computations, which still show an ROIC significantly greater than its WACC. This shows that McDonald's have effectively fended off competition from eroding their competitive advantages. I choose to be a conservative investor, like Mr. Buffett, so I do not typically want to pay for growth, as that adds an additional element of risk. So, if we want to invest in McDonald's on the basis that there will be zero growth moving forward, then we will only buy the stock if the price falls below $170.86 per share. However, I and some other value investors are willing to invest in a company based on their intrinsic value with growth if we can meet some certain criteria. First, I need to be able to get a 50% margin of safety, which helps compensate for the uncertainty of growth. And second, I also aim to see these 3 conditions met before I invest on the basis of growth. First, the growth rates of revenues per share, EBIT per share, and earnings per share must all be above the current rate of inflation to ensure that I am not paying more just for inflation. Second, the second pass ROIC must be greater than the company's WACC, which shows that the company is able to create shareholder value per additional dollar invested in the firm. This ensures that the company has a high likelihood of creating value with the additional CapEx required to grow. Third, I need to see that the company has an 80% or greater probability of sustaining its competitive advantages. This is by far the most important part of my growth analysis, as it's the most forward-looking factor. However, it would take me about 30 minutes to explain this analysis in detail, and in an effort to preserve your time, I'll summarize all of the analysis I did in a summary chart. Please take a moment to read this analysis, as it explains exactly why McDonald's is one of the most valuable brands and companies in the world. As these images flash across your screen and you give them a read, if you find yourself confused by anything in here, feel free to drop your question or comment below and I'll get back to everyone. I'm also considering starting a series on my channel where I cover the most successful business strategies in all of the stock market's history. If you're interested in seeing this type of video and would be interested in seeing McDonald's featured there, please let me know down in the comments below. So now, after finding that McDonald's has passed my 3 growth screens by a comfortable margin, I need to compute the value of the firm with growth. On your screen is the updated free cash flow schedule and an updated EPV analysis that needs to be made for McDonald's if we want to assess the value of growth. In the case of McDonald's, the no growth free cash flow schedule and the adjusted EPV analysis have immaterial differences as shown on your screen. I made these adjustments so that I can use something called a value of growth multiplier, which I will showcase later on in this video. However, we first need to look at the third pass ROIC. What I found is that because there were no major material differences between the free cash flow schedules and the EPV analyses, there was no real material difference to the third pass ROIC from the second pass. However, the material changes to McDonald's valuation come from the computations on your screen now. These computations show the intrinsic value of McDonald's with a value of growth multiple. I use two methods to determine the value of growth multiplier. Using method 1 and holding the value of growth multiplier at 1.5, I computed a nominal growth rate of 1.04%. This is fair because the market is predicting 0% inflation given the low risk-free rate. Using method 2, I determined a fair growth rate of 1.05% by looking at the past real growth rates per share and finding the average growth rate in EPS over 5 future years if the current decline in growth rates is to continue. This was very conservative and it yields a VGM of 1.51. A less conservative investor could assume inflation will continue, and they could choose not to factor in declining growth rates, and their analysis would show a much higher intrinsic value with growth. The intrinsic value with growth then comes out to be $457.98 per share using method 1, and $460.35 per share using method 2. So overall, would I buy at current prices? Yes. I would buy McDonald's at current prices, and I have been buying the stock since the March lows of this year. However, if the stock price is to move above $228 per share, I won't be buying any more shares. This is because I won't be able to receive my 50% margin of safety on the intrinsic value with growth. So some of you may be thinking, okay, this is McDonald's valued from a value investing perspective, but what about from other perspectives? For those people, I have also completed a traditional DCF and comparable companies analysis on McDonald's, but it would have taken far too long to cover those analyses in this video as well. The reason why I love McDonald's stock is because I've made a comprehensive professional initiating coverage report on the company that has significantly more detail than this video for my keener viewers. If any of you want to see this file, which got me interviews at the best investment firms in Canada, let me know and I'm happy to send it your way. Finally, we want to consider what potential risks could ruin our investment. First, the selling, general, and admin expenses are reducing as a percent of sales, which is normally a good thing. However, the SG&A expenses are also reducing as a dollar value, which means that McDonald's is cutting jobs. While eliminating redundant jobs and employees is a good thing, it can be an awful thing if McDonald's is to go too far. Research in the field of organizational behavior has shown that the long-term prospects of a company can be significantly damaged from excessive downsizing and layoffs. Poor employee morale, poor idea generation, and numerous other risks could easily wipe out the competitive advantages McDonald's enjoys if they are not careful here. Second, senior executive turnover has been above average in the past couple of years. This is a risk because the firm is leveraged at a higher than average rate. As debt is recycled, adverse funded debt and coverage ratios will make it harder to get favorable rates. What would make the situation worse is if a senior executive, like the CFO, is to leave, which impacts the company's ability to structure their debt in this way. This is because one of the 4 C's of credit, or the 4 C's which are used to analyze the creditworthiness of someone, is character. The final risk that McDonald's faces is pressure from their franchisees. For example, if employment laws are to change and franchises have to expend significantly more capital for wages, they might come back and request that McDonald's take a smaller fee or lower their overall rent payments. This can adversely affect McDonald's debt repayment plan, as well as a variety of other things. In summary, McDonald's has lower risk than most investments from a traditional finance perspective, low beta, and from a value investing perspective, low business risk. Yet buying or adding to the position at the right price has the potential to deliver extraordinary returns. Therefore, no one needs to throw money at highly risky investments, unproven companies, and penny stocks to achieve phenomenal returns in the stock market. Always remember to be eager to learn, willing to invest, and prepare yourself for success.